Amin Reina here from Sage Investors, and this is take number 8. This week, we're going to get a lot of chatter from the central banks. They're going to be testifying or having some meetings and making some decisions on the direction of interest rates. And we're going to hear a lot about inflation and inflation targets, specifically the central banks targeting getting inflation back, essentially back to around 2%. And what they're trying to do is they're trying to recreate the conditions of what economic times were pre-pandemic and essentially how we've been living for the last 20 plus years. And that's really with a low inflation environment, which has basically fostered cheap labor, cheap goods, cheap money. And the reality is, I'm not sure if that's really happening. I don't think we're going back to a whole globalization of supply chains. I think we're going more to a regionalization of supply chains. I don't know if we're going back to a world where we're, hardcore into highly efficient, just-in-time inventory management type systems. I think we're going to a world where companies are going to be carrying more inventory. Companies are going to be fostering or carrying higher levels of materials and final goods in their inventory just for those particular crisis type situations. I don't think we're going back to a world where we're going to pay people like minimal wages and creating such a inequality in terms of people's standards of livings. I think companies are definitely in the process right now of coming to grips with paying more wages, but they're looking at alternative mechanisms. They're starting to recalibrate their processes, their systems, their manufacturing processes. And unfortunately, that's going to bring a certain level of automation into play, which is going to further, potentially exacerbate the situation, maybe exacerbate the level of inequality that we're seeing in society right now. And finally, I don't think we're going back to a world where we're just going to keep going and polluting our planet. If there's anything that's come out of COVID, is that the reality is the planet is changing and it is fostering and creating environments that are allowing for the creation of new types of viruses and diseases that are going to impact us. And the reality is, I think we're going to start moving towards, it's going to take a long time, but hopefully I think this has been a wake up call for us to take care of our planet a little bit better. So yeah, inflation is coming down. It's going to come down from the pandemic, fest that we had a couple of years ago. But I don't think, and regular listeners and followers who have been, looking at me, I don't think it's coming back to a level of 2%, which is what the central banks are targeting. I really don't think they've kind of figured out or realized or had that aha moment that we can't go back to those kind of times and that kind of dynamic that we were operating. I don't think it's as realistic right now. And I think the markets have also been in a level of denial about it, but I think it's starting to sway. It's starting to get priced in a little bit. The thing is, like, if central banks, if we keep hearing this hardcore attitude of like, we got to get inflation down to 2% before we start dropping rates and doing anything or being successful, the risk here is, and this is the risk factor, is that what is the level of collateral damage that's going to be done to the economic environment? What's going to be the level of damage done to business? Reality is, if interest rates stay elevated, if inflation stays sticky and settles at a higher level, that's ultimately going to feed into lower profits, lower demand for goods. People are going to hold back on spending, and ultimately it's going to feed into lower stock prices. And that is why right now, and this is why we're in such a very interesting time as an investor, is that the whole value proposition, while not, totally gone, the whole value proposition for holding stocks, it's really hard to do it right now when, I can go and get a 6-month T-bill and get 5% yield for basically minimal risk. The question we're all asking, and a lot of investors are starting to ask themselves, why do I want to be exposed to so much risk when I can get much lower risk alternatives at a higher yield? And that's kind of the debate that's kind of happening right now, I think, with investors. So we'll see what happens, but yeah, it's a pretty delicate time. And so we're going to hear a lot of chatter about 2% targets. Not so sure about that. That's my take. If you want some more info about other takes, you can find me on my website, sageinvestors.ca. You can find me on Twitter. You can find me on LinkedIn. Just do a search for Sage Investors and find more information about the coaching services that I offer and also the investment courses that I teach. That's it. That's all. Thanks. Have a good day. Bye bye.